Hi, this is Jason, Chief Technical Analyst with your weekly market recap for the week ending March 24th. We had another volatile week in the markets with the FOMC meeting this week, issuing another 25 basis point rate hike, as well as fear and uncertainty around the banking sector still, with new fears emerging out of the European banking space, ultimately driving a lot of that volatility. So let's dive into the charts and take a look at what we're seeing. Starting out with the cryptocurrency total crypto market cap, we're sitting over $1 trillion still, but we have kind of chopped around mostly sideways on the week, sitting at about 1.12 trillion for the total cryptocurrency market cap. When we jump over to the Ethereum chart, we see a very similar pattern, just a lot of volatility bouncing around between 1730 and about 1850 on Ethereum. So the question on Ethereum is this a bit of a bull flag before we move higher, or is this more of a topping pattern? Are we going to reverse and correct from here? When we take a look at the Bitcoin chart, it looks to me more like a topping pattern here. The Ethereum chart could look a little bit more like a potential bull flag or potential topping pattern, but with the Bitcoin price action definitely looking like it's more of a rounding top at this point. Did have a brief spike up, almost touching that anchored VWAP close to 30K today, but then it sold off pretty aggressively from there. So this Bitcoin chart specifically is starting to look like more of a topping pattern, so I'm expecting a possible correction from Bitcoin and likely from the entire cryptocurrency asset class space if that does occur. But we need to see a breakdown probably between about below 26.8 or so. And if we see that, then I'd expect a fall back down to retest at least this anchored VWAP at 25K. Bulls will probably want to see that hold. And if we can hold 25K, then I think we likely head higher from there. But at least in the short term, my best bet on Bitcoin is that we'll likely see some form of a correction, whether or not we just retest that 25K or if we ultimately see a bigger breakdown and see a deeper correction. I think that'll largely come down to what the triple Qs and the broader markets are doing and what happens with more concerns around the banking sector in the coming weeks. Taking a look at the traditional markets, jumping over the SPY, pretty volatile on the week, but ultimately finishing just slightly higher than we did open the week at. But definitely a lot of price action moving up and down throughout the week, a lot of intraday volatility around the concerns in the banking sector, as well as the Fed actions for the week. Ultimately, the SPY finished pretty nicely above a pretty major volume support and resistance zone around 395. We did close 395.75. It looks like after hours on Friday, we're moving up a little bit above that as well. So that 395 is a pretty key level. I think if we're above that 395, that's arguably good news for the S&P 500, but as we can see, we have been kind of chopping around up and down above that level. So we really want to see some further follow through and ultimately see price action get above probably about 400 again on the SPY to get a little bit more constructively bullish. Right now, I'm just kind of staying somewhat neutral, looking for a little bit more definitive move out of the S&P 500 one way or the other. We see SPY drop below 386, I'll definitely be looking a lot more bearish. But if we can see it break above this descending wedge trend line and get back up above 400 on the SPY, then I think we can start getting a little bit more bullish in the markets. But still kind of in this kind of on no man's land right now. We need to see a more definitive break, either below that 386 to get super bearish, or a clear break above 400 to get a lot more bullish for the S&P 500. And when we take a look at the breadth measures for the S&P 500, we can see that while we did get all the way back up to that 50% level, we sold off below that to finish the week up, and we are only at about just below 43% of S&P 500 stocks above their 200-day moving average. Really want to see it get back up above that 50% level to get more bullish as well. So we still have not seen that happen yet, and we're also seeing not a huge correction in the S&P 500 stocks above their 50-day, currently sitting at just about 23%. So from a breadth perspective, we need to see some improvement here as well before we get super bullish. And we just have not seen that yet. Take a look at the triple Qs. The triple Qs have really been outperforming both the Dow and the S&P recently, so we've seen a big outperformance out of growth, and it looks like that's still trying to continue, as we did see a bit of a negative territory for most of Friday. But then towards the end of the day, we ultimately saw the triple Qs get back up above this anchored VWAP at about 309.50 which is a pretty key level. That was off of our COVID lows. And then our next anchored VWAP to contend with is from the all-time highs on the triple Qs, which is at about 316. So if we can see triple Qs follow through to the upside from here and actually put some closes in above that 316 level, I think you got to be pretty bullish on the NASDAQ, but also kind of in a bit of a no man's land, as we've ultimately been at this range a couple of times recently. And this has been kind of where it's got people a little bit excited, and then we've ultimately rolled over from here. So need to see some further price action going into next week. Again, if we can get above that 316 on the triple Qs, I don't think there's anything other than a bullish hope there. But if we are seeing a breakdown and ultimately see that triple Q drop below that other anchor VWAP at 309, then I think we've got to be a bit more cautious. Take a look at the Dow Jones Industrial Average. We are still below the 200-day moving average, so we want to see price action next week get back up above that level if we're bullish on the markets. Haven't quite got there yet. We did get above there, looks like on Wednesday and Tuesday, but it didn't hold very long and ultimately rolled back over. However, we are above the COVID low anchor VWAP level, which is at that 316, and that was actually a level that we kind of found support at previously. So that would be really kind of my line in the sand as far as being really bearish for the Dow. If we see price action drop below that 316, then I think we got to be pretty bearish for the industrials. But right now we're kind of in that no man's land as well, and we want to see price action get above the 200-day at least if we're looking to be long the Dow Jones Industrial Averages. And then we take a look at our transports, also below the 200-day moving average. We want to see that resolve as well, back up above that 200-day moving average, which is just below 14K on the transports. So we need to see a little bit more price action to the upside on the transports to get bullish here as well. Take a look at our Russell 3000 chart. We are kind of also in a bit of a no man's land here. We did get back up above this trend line that we've been stuck below all of 2022. So that's arguably more constructive and a better look than what we closed out last week. However, we did close the week out below our 21-week EMA and SMA levels, which is our yellow and blue lines here on this chart. So we want to see price action close hopefully next week above those levels if we're looking to go long the markets, which we still have not seen quite yet. So hopefully we'll get some further follow through to the upside next week where we can see price action close above those levels, and then I think I'd be a lot more optimistic for the markets, but still kind of in a bit of a uncertain range here. And then we jump over to our New York Stock Exchange new highs and new lows list. We can see that we've kind of got both actually increasing right now. So we're starting to see some new highs start to increase over the last few days and on that green chart there. But on the red one, which is our new lows, we're also seeing an acceleration in new lows as well. So a bit of a mixed bag across the markets for our new highs and new lows list, but we are also below the zero line here. And when we scan back and look at 2022, we spent most of 2022 below that zero line, and as we know, 22 was a pretty tough year, not a great year to be long, and we are below that zero line once again. We got right back up to that zero line just a few days ago, and then ultimately corrected off of that level. So we want to see that new highs, new lows list get above that zero line as well before we get super bullish also. Jumping over to our Russell 1000 for our large caps, we did get above our descending wedge trend line like we did on the Russell 3000, so that's a bit of a positive development for our large caps this week, but we are still below our 50-week moving average, and a lot of those gains, we actually saw a much bigger gain on large caps this week, but most of that was given back before the week closed out, so not for an individual weekly candlestick, not a great look. And so the big question is, do we hold that support line and move higher and get above that 50-week next week, or do we ultimately see the markets reverse from here? So a bit of some uncertainty there on our large caps as well. Take a look at our small caps. Small caps were actually looking much worse this week. We ultimately dropped below this 170 line, which I think is a pretty key level for our small caps. As we can see, just even in recent past, we've had multiple, this has been a pretty key area for the correction in small caps, and we've ultimately found support many times right around this 170 level. We did see a couple of brief dips below that level, a couple times last year, but that 170 line's been a pretty big line in the sand over the last almost a year or so now. And while we did open up opened up the end of the week here on Friday below that level, we did see a pretty nice surge back up above that 170 level. So that's a bit of hope and optimism. I think if the small caps had ultimately closed the week out below 170, I'd be a little bit more concerned and thinking things potentially were a bit more bearish. But we're kind of also in this no man's land where we're still below this major trend line, but above that 170 line in the sand. So definitely need to see some resolution one way or the other next week. If we get a close below the 170 line, definitely more of a bear signal. If we can get back up above 173.50, which would get us back up above this descending wedge pattern trend line as well, things would look a lot better for our small caps. And then jumping over to our large caps versus small caps ratio chart. So when we're going up and to the right, small caps are outperforming large caps, and when we're going down and to the right, we've got large caps outperforming small caps. And so we've seen over about the last month or so that small cap outperformance really reverse, and we're starting to see large caps pretty significantly outperform small caps. We can also see that we've had a pretty strong trend line at this 0.79 level on our small caps versus large caps, and that's oftentimes been a pretty strong area of support over the last year or so. So we did just get below that level on the week, but ultimately closed just slightly above it. So next week we'll see if we get ultimately a reversal. Maybe we'll start seeing small caps move up from here and start to outperform large caps, as that has been the trend over the last looks like 3 or 4 times we've been at this level. So it'll be a key level we'll be watching going into next week. And then when we take a look at our growth versus value chart, we can see that growth is continuing to outperform value, and that has continued to head higher. So the NASDAQ still and other growth stocks still the clear winners here over a pretty decent period of time. We really have seen growth start to outperform going all the way back to beginning of January this year. So really all of 2023. Growth has been the place to be, and we'll see if that can continue going into next week, and hopefully the markets will find a bottom, and maybe we'll see markets head higher from here. And then when we take a look at our consumer discretionary versus consumer staples, a little bit of concern here as we did drop below this 0.738 level, which was a pretty strong area of support and resistance over the last few years, and we are below that level. However, we are above our 50-week moving average, but we are pretty significantly below all of our other major moving averages, like our 200-day or 200-week rather, 50-week and 150-week. So we definitely want to see that 50-week hold. I think if we lose that, then that would be pretty concerning, I think, for the markets broadly. Typically, when consumer discretionary is outperforming consumer staples, that's usually a risk-on signal for our markets. And over the last few days, or last few weeks rather, we're starting to see consumer staples take the lead over consumer discretionary. And so if that continues, that's definitely a warning sign for the markets. But we are still above that 50-week moving average. So as long as we stay up above about 0.71 on this ratio chart, then hopefully things will hold up in the markets. But if we see a clear breakdown below these levels, then I think we definitely need to be pretty bearish for the markets. Take a look at our bond market, TLT on the top chart, IEF on the bottom chart. TLT actually had a close to finish the week out above our 200-day moving average, which is pretty impressive. We've been below that 200-day moving average on the TLT for quite some time, as the bond market really got beat up significantly in 2022. But starting out in, looks like we were in about October when the bond market started to reverse, and we had a pretty nice move to the upside going all the way into December of last year, and then we've kind of been chopping around sideways on the TLT. So, but none of these, all the sideways action was pretty consistently below our 200-day moving average up until recently, and we obviously saw a lot of bond volatility in the recent past, and some big moves that don't typically occur this quick, a big gap up and some just crazy price action on the TLT. This is looking more like a stock chart than a bond chart right now. So definitely kind of unusual volatility and huge volume coming into the bond market. And I think ultimately what this is likely signaling is that we're probably going to see a pretty big move in the bond market to the upside in the fairly near future. But we definitely need to see at least a few days of price action close above that 200-day moving average to get super bullish, as we can see over the last few weeks. We've had a few days where we did get above that 200-day moving average, but really struggled to stay above those levels so far. So if we can get some follow through going into next week and we see that 200-day moving average hold with support, then I think that's a pretty nice tactical entry on a bond trade. I'm actually probably be looking for some longer dated call options to potentially get some nice upside in some bond plays if we can see that 200-day moving average hold up. And then when we take a look at our IEF chart on the bottom, we're actually seeing multiple days above the 200-day moving average, so the IEF's actually looking even stronger. And if we can see price action get above the 100 level on the IEF, I think that's likely an all clear for the IEF to head higher as well. And we'll be targeting some upside price targets between about 105 and 106 on our 7 to 10 year bonds. Taking a look at our sectors that we track each week for the last trading week, we can see at the top here the leaderboard. Solar had a pretty good week, up over 5%. That was the clear leader on the week, but we saw quite a few other sectors do pretty well. Communication services 3.3%, lithium up 3.2%, and then we've seen some real strong performance out of precious metals with the gold miners up 3.2%, silver, SLV up almost 3%. Also seeing some strength out of emerging markets and starting to see the XOP and energy start to bounce off some levels as well. And then towards the bottom of this list, we're seeing natural gas still towards the bottom here with down about 6% on the week. Seeing cannabis down almost 4% and ARC FinTech down almost 3.5%. So most of our sectors were in the green on the week, but there were a few sectors that were down a bit, and most of that volatility we saw was kind of intraday, and that's why ultimately a lot of our sectors kind of were fairly sideways with not any major big moves in either direction. And then jumping over to our global charts, the VEU, so this is the global markets minus the United States. We are above our 50-week moving average. However, we are below this 52.20 level, which is a key area of support and resistance. So we did push up against it on the week, but ultimately couldn't hold that as support. As long as we're above that 50-week moving average, I think there's reasons to be optimistic. But if we do lose that 50-week moving average, then I think we've got to be pretty bearish for the global markets, and we're not too far off that level. So still definitely more on the neutral side when it comes to global markets. We want to see some follow through to the upside, get back up above that 52.22 level on the VEU, or a clear breakdown below that 50-week if we want to be more bearish for the global markets. Jumping over crude oil. Crude oil has for 2 weeks now found support at that 200-week moving average we've been talking about for quite some time, looking for that as a potential bottom on the oil prices. Still kind of unclear whether or not that'll ultimately hold, or whether we do see a little bit more price action to the downside. I think the oil markets are starting to price in recession concerns, and energy prices or energy demand typically drops significantly during a recession, and so it's still unclear whether or not that 200-week will hold. If we do see it not hold, I don't think we'll see a massive breakdown in the oil prices. I don't think it'd be too much further of a drop. Maybe we drop down to 60 or 55 a barrel if we do see that 200-week fall. But right now it is holding as support, and we've got 2 weekly candlesticks kind of holding that and respecting that as support. So far so good on that 200-week holding, and if we can see a little bit more follow through, we start to see oil prices head higher from here. That could be a signal that the bottom might be in for the energy space, but probably need a little bit more price action to ultimately make that call. Jumping over the commodity index, the CRB index, we did start to see a breakdown after we did a bunch of sideways price action for multiple months between that 265 and about 285 or so on the CRB. Definitely a clear breakdown over the last couple of weeks, although we did see a little bit of price action to the upside on the CRB index, but ultimately most of that previous week's declines are still in place, and we are now got 2 weekly closes below our 100-week moving average. So definitely looks like the trend is to the downside on the CRB for now. Take a look at our precious metals, starting out with the GLD. So the gold markets did top out over the last couple of days at this 186 level on the GLD. Not a huge surprise, as that's been an area of resistance in the recent past. And so big question is this a bit of a top for now, and are we going to correct a little bit? or is this just a kind of a brief correction at a kind of a level we sort of expect at least a pause in price action, and then do we ultimately head higher from here? A lot of that I think is going to come down to what the interest rate market does over the next few weeks, but right now it's looking like rates are at least sideways to down from here, and so a good chance that maintains itself, that we'll likely see higher prices in our precious metals. Still long both some gold and silver commodities, as well as some of the gold and silver miners right now. Jumping over to the gold futures, we also saw a bit of a topping pattern just over the last few days, just around 2,000 on the gold futures price, which is also another level. It's not super shocking to see a bit of a stall out. So just like with the GLD chart, big question is this just a bit of a stall out before we ultimately rip higher above 2K, or are we going to see a bit more of a correction? And again, I think that will come down to how the rates perform in the coming days and weeks. Take a look at our silver chart. The SLV closed the week out at about 21.27. Did come down a little bit on Friday, but we opened up higher to start the day out. Ultimately closed right about where we closed on Thursday. So still looking pretty strong for our silver markets. However, we do, if we zoom out, looking at the SLV chart, we can see that we're still kind of stuck below this descending wedge pattern. So pretty key level I'll be watching for is a clear break on the SLV above about 20 or 22 or so. If we get that 22 break to the upside, and I think that's a real strong signal that we'll likely see silver head quite a bit higher, and I'd be looking for a move up to at least 27, 28 on the SLV once we get above that level, but we're not quite there yet. So we'll have to keep a close eye on silver and see if this is just a little bit of a correction, or if we're going to be able to push straight through that 22 level and ultimately head higher. And then we take a look at the silver futures index. We can see that we got up to about 23.70 or so on the day, but most of those gains were given up to close the week out with about 23.34 per ounce on our silver futures contract. Pretty aggressive move on silver. We were sitting at about just below $20 an ounce at the beginning of March, and we've moved up pretty significantly from there. So big question is, just like with the SLV chart, are we going to roll over from here and correct a bit, or is this just a brief pause before we push through and ultimately head higher on precious metals? So I think next week will be some pretty good information on the precious metal space to see if it's just a brief correction or if we ultimately start seeing prices break down. But I still think longer term precious metals are going to be a great trade going forward, and I think we got much higher prices coming in 2023 still. Take a look at our interest rates. Our 3-month is sitting at 4.56%. We ultimately saw a pretty big breakdown as we were not too long ago pushing 5% on our 3-month. So we've definitely seen a bit of a decline, and now we're kind of chopping around sideways on our 3-month interest rates. 2 years had a massive decline. We were sitting over 5% at the beginning of March, and now we're sitting at about 3.75% on our 2-year, and dropped below our trend line here as well. So definitely looking like rates are heading lower on our 2-year rates. Jumping over to the 10-year, we closed the week out at about 3.38%. Also a big decline off the 10-year rates, as we were above 4% not too long ago, and now significant decline in just less than a month's time, all the way down to 3.3%. Looks like we'll likely either head sideways or lower. We're also below our 200-day moving average on the 10-year interest rates as well, so things are looking like they are at least sideways to down for rates right now, and I think we're definitely topped out on our rates. I just can't see a scenario where we're going to ultimately get back up above 4 or even to the previous high at about 4.28%. Taking a look at our 30-year, we're sitting at about 3.65%, still above the 200-day moving average, but we have been testing that multiple times, so we'll see if in the coming weeks we can ultimately see the rates drop below that level as well, but we're closed out the week at about 3.65%. Then jumping over to the euro-dollar futures, looks like we're suggesting about a 5% Fed funds rate. So when we take 100 minus the euro-dollar futures, that gives us an implied Fed funds rate. Not too long ago, we had a pretty significant gap down, and there was some concerns that we were looking at upwards of about 5.75 to maybe even 6% Fed funds rate. That quickly reversed, and now we are looking at closer to 5. So I think that's telling us also that the tops and rates are likely in, and the most likely direction going forward is lower rates going forward. But obviously the Fed's going to try to keep those rates as high as they can for as long as they can, because that's what they're trying to do to deal with the inflation concerns. But if we do ultimately see a big shakeout in the markets, and the markets have any kind of major correction or crash, then they're going to have to probably adjust those plans. Jumping over the dollar, the Dixie chart, we've been seeing a weaker dollar recently, but these last couple of days it looks like we put in at least a short-term bottom and starting to see the dollar head a little bit higher. A higher dollar typically is bad news for the markets, so but we are still below our 50-day moving average on the DXY. So we'll see if that continues to follow through and break above the 50-day next week, or if that's ultimately going to be a top, and then maybe we continue to head lower on the dollar. I think if you're a bull for the markets, we'd like to see that dollar roll over and continue to head lower and provide some support for a rally in the markets. When we take a look at our high yield corporate bond ETF, another macro chart that I like to look at for overall health in the markets, and while we did move up higher on the week, most of those gains were given up, and we ultimately closed just slightly higher than we did last week. So still not rolling over from here, and it looks like we're ultimately holding support above that 73 level on the HYG. However, it's also not looking super bullish either, so still kind of some indecision here, and we need to see a more definitive breakout or breakdown on the HYG chart to make a better call from here using this chart. And then another one that I've been watching closely is LQD divided by IEF, which is investment grade bonds divided by the 7 to 10 year bond. So this chart has been a very strong indicator towards market health, and I've actually gone back through the chart for multiple years, all the way back to the Great Financial Crisis, taking a look at when these EMA and SMA lines cross for kind of warning signs for market health. And so each time, the white line is our 13-week EMA, and our purple line is our 13-week SMA, so that represents 1 quarter in the markets. And each time we've seen this white line cross over the purple line, that's been a pretty negative signal for the markets, and the markets have tended to sell off from here. Doesn't necessarily guarantee a crash in the markets, but it's definitely not a bullish sign. And as we can see here, if we zoom in a little bit, we are getting pretty close to a potential cross. Although it wouldn't take much for some further follow through to the upside on this chart next week to potentially avoid that cross. So we haven't crossed yet, nothing to be concerned about yet. However, we're getting extremely close with that EMA and SMA line. So definitely watching this chart really closely. Need to see how it resolves over the next week or two. If we can avoid that cross, then I think that'll be a pretty bullish sign for the markets. However, if we don't avoid that cross and we see that white line cross below the purple, I'll definitely be taking a much more cautious and bearish approach to the markets, but that hasn't happened yet. So, and on the inverse side of that, we can also see that pretty often when we have seen the reversal where the white lines cross the purple, which has obviously been a bullish sign, each time that's occurred, going all the way back to the Great Financial Crisis, each time we've seen that cross to the upside, we've ultimately seen price action drop below those lines briefly and then ultimately ratchet higher. So that's also what we're seeing right now, as we saw price action drop below those lines and trying to ratchet back up above that. So this could just be a normal signal that we tend to see with this chart, and then ultimately head higher from here, and that would be a bullish sign. So this chart, depending on how it resolves, could ultimately be giving us a really bullish signal or a very bearish signal in the coming weeks. So I'm watching this chart very closely to ultimately get a stronger indication as to where our markets are likely heading from here. And then we take a look at our put call equity ratios. I did see a pretty massive spike this week, ultimately closing or almost getting up to about 1.5 again. We can see over the last 3 weeks we've had periods of time throughout that week where we just about pushed that 1.5 number, which is elevated put buying protection. However, we gave up most of those gains on the week for our ratio chart here, and now we're sitting just below that 1 level, which is considered more normalized ratios. And so we did not close the week out above the 1 line, which is arguably maybe not bullish, but not super bearish either. And so we'll keep a close eye on that going into next week as well. And then taking a look at the VIX chart, as we can see, we've seen some pretty massive spikes in the VIX and ultimately saw a move back up above 25 for multiple days, which really hadn't occurred We have to go all the way back to November of last year. Last time we had multiple days of the VIX above 25, but ultimately this week we've basically seen the VIX drop below 25. Really on Monday was when we dropped below 25, and then there was multiple attempts to get back up above 25, and each of those have failed and failed pretty significantly. So closed the week out on the VIX at about 21.75. and have not been able to get back up above the 25 level, so that could be viewed as somewhat bullish. As long as we aren't back up above 25, I don't think the markets are going to be collapsing from here, so that's somewhat constructively optimistic for the time being. And I'll go ahead and close the week out with one chart, taking a look at the XLF, the financial sector ETF. So 31 is a really key level that I'm watching here. 31 was our former highs before the great financial collapse in 2007. We can see that as we're looking at the left side of this chart here. We've got that 31 level marked. We got all the way back up to it a couple of times before COVID crash. Never were able to get quite back above it, and then obviously we had a pretty massive surge well above 31 as the markets recovered from the COVID lows. And so we are now once again back down, kind of testing those levels, and we ultimately did break down below them a little bit this week. If we zoom in a little bit more, this is a weekly candlestick. We can see that we did ultimately dip below 31. I think we might have even had a daily close below that level, but ultimately we closed the week out just 1 penny below that level, and when I looked at the aftermarket, it looks like we're slightly above that level, so we're just right at a key level here for the financials. And so that's something we'll be watching closely next week as well. If we see a major breakdown on the financials, see it drop below 31 again, and ultimately see some closes below that level, especially if we see a breakdown below 30 or so on the XLF, then it's pretty hard to be super bullish on the markets. But if we see that 31 hold and we see the financial sector not fall apart, with that being some of the biggest concerns in the market right now, then I think that's arguably a pretty bullish sign if we can see that 31 hold. So that'll be another key chart I'll be watching going into next week. So thanks for tuning in, and make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto, and you can always check us out at ToroAlerts.com.